A life insurance policy is simply a contract between two people, an insurance policy owner and an insurer. While I go into much more detail about this in another video, in this video I want to dive into a policy illustration to show you why it's the most incredible place to hold money. Most people agree, especially after seeing and understanding how the numbers work in a properly designed policy, that this is truly the most phenomenal place to hold money. And I usually always get questioned about why people have never heard of this before, even though this exact strategy has been being used for hundreds of years. This policy has been in force, which simply means that it's been in place for almost 10 years. It was designed for a 41-year-old male that does not smoke. He's putting in $8,000 a year. We are overfunding this policy. What that means is that it was designed to quickly grow and maximize cash value predictably and safely. Notice there are two columns on this illustration. The first column is called Guaranteed Values column, which means just that. These values are guaranteed. As long as the policy owner maintains his part of the agreement or contract, which includes making the annual premium payments, the company will pay the guaranteed values to the policy owner. The second column is called the total values, including non-guaranteed assumptions, or more commonly known as the non-guaranteed values. The reason there is a non-guaranteed column is because this company pays dividends. Dividends are what the company pays to the policy owner annually if the company has strong financial results and a lower than expected number of claims. This is a mutual company that also allows its policy owners, which is why I call them policy owners instead of policy holders, to share or participate in the profits of the business. The dividends are classified as a return of overpaid premium, so the dividends are not taxable. The dividends are variable and are not guaranteed. So the numbers illustrated in this column are not guaranteed, but are carefully calculated by the company to be an accurate, as they can be, prediction of future values. So let's get into what I love, the numbers. Let's go across the rows. In the first year, he's 42. And please notice that these values are being calculated for an end of the year. He paid $8,000, as shown in the annualized contract premium column. On the guaranteed side under the cash surrender value, it shows after his $8,000 premium payment, he has $4,928 available to him. Okay, side note. The cash surrender value is how much the policy owner would be paid if he surrendered the policy at this time. While we are not going to be surrendering the policy, we do want to be accessing and using the cash value. So not all of the cash value is available to us, but almost all of it, and it's close enough so that we'll be using the cash surrender value in this analysis to represent what is available to him. So let's continue. There's $206,828 guaranteed death benefit. And on the non-guaranteed side, there's an annual dividend of $52. A cash surrender value of $4,973 and a death benefit of $207,023. I want to pause here now. I want to make sure that one of the most important concepts to the infinite banking concept, or the bank on yourself, or family banking, or a life insurance policy designed for the living, or whatever you want to call this strategy, that it's understood. and it's called the cash surrender value. Under both the guaranteed and non-guaranteed value columns, the cash surrender value is the amount of money that is available to the policyholder to use. The money has been called your bank or your private reserve or your pool of wealth or recycled money. There's many different names, but please understand that this pool of money, the growing and the using of the cash surrender value, is one of the most important reasons, if not the most important reason, that we are putting our money into this type of vehicle. So let's continue. In year 2, he pays the $8,000 premium. And his cash surrender value went up to $10,938. Or on the non-guaranteed side, $11,172. The numbers that are extremely important here is the amount of increase to each of these surrender values each year. Side note, our society has become obsessed with finding better investments and higher rates of return and higher interest rates and so on, which almost always means introducing our money to risk. I understand that maybe for some people they don't mind the risk, but I do mind the risk. I believe what is really important is to understand the basics of how to handle our own money and business basics. The business basics that I want to address right now is the understanding of starting a business. Let's say that we want to start a grocery store. We have to buy the land, build the store, stock the shelves, hire the employees, spend a lot of money before we even make a penny. My point is that I want to look at this policy, the illustration, and compare it to a business plan. The first few years will show a loss until things get rolling, but once they get rolling, hang on. So with that being said, let's continue and look at the guaranteed cash surrender value of the $10,938. The year before it was $4,921. That's an increase of $6,017. But there was actually an overall loss of 24.79% of the $8,000 premium that was paid. On the non-guaranteed side, he went from $4,973 to $11,172. That was an increase of $6,199. There was also an overall loss of about 22.51% of the $8,000 premium that was paid. Year 3. He pays the $8,000 premium, and the guaranteed cash value went up to $19,157. That was an increase of $8,219. And actually, a positive growth of about 2.74% on the premium that was paid. Now the non-guaranteed side went up to $19,697, an increase of $8,525. which is also a growth of about 6.56% from the $8,000 premium that was paid. So, question. Look carefully at the numbers. What do you notice? How much was the cash value? How much was the premium? How much did the cash value go up? The premium was $8,000. The cash values went up $82.19 and $85.25. This year, the increase in cash value is more than the premium that was paid. This is what I call a first level of parity in this policy. When the increase in cash surrender value is more than the premium paid, we are making great success. We're also now showing a positive percentage of growth. If you're good at numbers, you might have already figured out that he's put a total of $24,000 into this policy so far. But he only has $19,157 guaranteed, or the $19,697 non-guaranteed cash surrender values. But let's continue. In year 4, again he pays the $8,000 premium. The cash surrender value went up to $27,630, an increase of $8,473. On the non-guaranteed side, the cash surrender value went up to $28,620, an increase of $8,923. Or, if we're trying to put these growths into perspective, this went up 5.91%, and the non-guaranteed side went up 11.54%. In year 5, again he pays the $8,000 premium. The cash surrender value goes up to $36,358, an increase of $8,728. On the non-guaranteed side, he went up to $37,945, an increase of $9,325. Once again, if we want to take a look at these two as percentages, the $8,728 was 9.1% increase of the premium paid, and the non-guaranteed side went up 16.56% of the premium that was paid. Year 6 pays the $8,000 premium. Cash surrender value went up to $44,802, or an increase of $8,444. Or 5.5% of the $8,000 that was paid. The non-guaranteed side goes up to $47,128, which is $9,183. Or an increase of 14.79%. Year 7, again, he pays the $8,000 premium. The cash surrender value goes up to $53,494. That's an increase of $8,692. Or 8.65% of the $8,000 premium that he paid. The non-guaranteed side goes up to $56,731, which is an increase of $9,603. And that's actually 20.04% increase of the $8,000 premium that was paid. In year 8, again, he's paying the $8,000 premium. And the cash surrender value goes up to $62,470. And that's an increase of $8,976. Which is 12.2% of the $8,000 premium that was paid. And on the non-guaranteed side, he goes up to $66,772, which is an increase of $10,000, $10,041. And that's actually 25.51% increase from the premium that was paid. In year 9, he's again paying the $8,000 premium. The cash surrender value goes up to $71,741, which is an increase of $9,271. And the non-guaranteed side goes up to $77,277, which is an increase of $10,505. Or 31.31% increase from the premium that was paid. In year 10, he pays the $8,000 premium. The cash surrender value went up to $81,301. That was an increase of $9,560. Which is 19.5% increase from the $8,000 premium that he paid. On the non-guaranteed side, the cash surrender value goes up to $88,269, which is an increase of $10,992. Or 37.4% increase. Okay, side note. let's take a closer look at some of the overall numbers again, okay? After this year is 10 years. Even easy numbers. How much was paid into this policy after 10 years, right, at $8,000? Okay? We've paid $80,000 into this policy. How much in total cash surrender value is available? Guaranteed. It's $81,301. The non-guaranteed is $88,269. Do you notice anything really exciting about the numbers? Remember back in year number 3 we talked about parity? Back then, The increase in cash value was more than the premium that was being paid, reaching what I called the first level of parity. Now we've reached another level of parity. How much total, right, was paid into this policy at this point? $80,000. How much total is there available? $81,301 guaranteed, which is $1,301 more than was paid. An overall increase of only 1.63%. But on the non-guaranteed side, $88,269, which is $8,269 more than how much was totally paid into this policy, an overall increase of that of 10.34%. This is where I get really, really excited, because this policy has virtually cost the policy owner nothing to have it, and it's a policy that is going to pay its beneficiaries somewhere between the $346,000 or $381,000 in a death benefit. But let's remember, we're not overfunding this policy for the death benefit. That is just something that's a great code generation, but we're overfunding it to maximize the cash value. So let's take a look a little bit closer at the cash value. On the guaranteed side, our cash value grew $9,560. Now the premium was $8,000. The percentage of increase was 19.5%. How many people are making 19.5% on their money today? But wait, it gets even better. Okay, this is a 19.5% increase in the value of this money, and it's not taxable. So hold on, let's try to look at this like an investor then. In order to have 19.5% increase in our pockets after paying taxes, how much would we really need to make if it's taxable, like any other investment type of strategy? Well, we would need to know what the specific marginal tax rate would be. I have another video explaining effective tax rate versus marginal tax rates, but let's make this really simple. And after a quick search, I can find that the average American's effective tax rate is 29.8%. So let's say it's 30%. I like even numbers. Since the 19.5% value increase in the cash value is non-taxable, we would need to add 30% to compensate for the taxes we would have to pay, right, if this investment was taxable. So if you're following along, you would have to make the 19.5% plus the 30% tax rate, which equals 49.5% profit in a taxable investment, to equal the same amount of growth that is going on here. Also, let's look at the non-guaranteed side. It increased from $10,992 from the $8,000 premium payment. And that's a 37.4% increase, non-taxed, or equivalent to, we would have had to make 37.4 plus the 30% tax rate, which equals 67.4% conventional investment profit, to be the same as the growth that we have here. I hope this is making sense and starting to excite you as much as it does me. Let's continue. Let's jump down the road. It's year 34. Okay? He's 75 years old. It's an $8,000 premium, but if you're peeking ahead a little bit, this is the last year that you can overfund the policy with the $8,000 premium. The guaranteed cash value is increasing from the $363,572 to the $377,740. That's an increase of $14,168, or or 77.1%. How about the non-guaranteed cash surrender value increase? It went from 494, 563 to 519, 741. That's an increase of 25,178. Or these numbers get wild. A 214.73% increase from the $8,000 premium that's being paid this year. Where else can you hold your money that it will grow 77 to 214% untaxed, and you still have access to it? The next year, in year 35, he's 76 years old. And like I said, the premium has to be lowered from the $8,000 a year to the $3,055, which is actually the base policy. But let's look at what's still going on financially. He pays the $3,055 premium, and the cash surrender value goes from the $377,740 to the $387,108. That's still an increase of $9,368. Or 206.64%. The non-guaranteed cash surrender value grew from $519,741 to $541,37, an increase of $21,296. Or 597.09%. Let's jump to year 49, when he's 90 years old. This is the last year that he'll have to pay any premium into this policy on the guaranteed side. He pays the $3,055 premium, and the guaranteed cash surrender value increases from $493, $663 to $500,803. That's an increase of $7,140. Or 133.72%. And the non-guaranteed cash surrender value grew from $894,460 to $926,950, an increase of $32,490. Or 963.5% increase over what he paid for premium. Let's look at the next year, year 50. There is no longer a premium due, but just by living another year, the guaranteed cash surrender value still grows from 500,803 to 505,110. An increase of $4,307. And the non-guaranteed cash surrender value increases from 926,950 to 957,517. That's an increase of $30,567. I don't even know how to represent the growth of the money this year, right? As there's a zero expense paid out of pocket for a premium, yet just living one more year creates between $4,307 and $30,567 more dollars into his pool of wealth. The numbers are truly, the only word I can think of to describe them is amazing. The next thing that I want to point out is the very last year of this illustration. In year 80, his attained age would be 121 years. Yeah, I can hear you laughing, but I want to focus on the values first. In the guaranteed section, the cash surrender value and the death benefit. The cash surrender value, right, is 577,434. The death benefit is 577,434. On the non-guaranteed side, we're at $2,035,108 in the cash surrender value. The death benefit is $2,035,108. What you notice about it? They're the same, okay? And this is in a properly constructed life insurance policy. The cash surrender value will increase until it matches the death benefit. This is extremely important and a great way to quickly verify any illustration to make sure that it is properly designed. Too many times I see so many illustrations that the guaranteed columns disappear somewhere around when the policy owners are, could be 50, 60, 70 years old. So, and it's usually right when they're going to need them. What does that mean? Everyone usually asks me, and I'm pointing it out in their policies, when the guaranteed side stops. Those are very poorly designed policies. Well, for the policyholders anyway, right? They should be completely avoided simply for the fact that the risk you're taking with these types of policies is that if you do not die before the policy disappears, all the money that you paid into that policy is also gone. So with this particular policy that we're analyzing, two things can happen. The insured will die, and the beneficiary will receive the death benefit tax-free, or the insured will live out to be 121 years old, and the policy will what they call endow. Okay, the death benefit slash cash surrender value, right, can be paid out. And did you catch that? Can be paid out. So why do I say it that way? Let's talk a little bit about cash surrender values. Cash surrender values can actually be accessed two ways. One is by taking loans from the policy, which I have a whole other video about, and addresses why we want to do this, because we can velocitize our policies. The other way is by surrendering the policy. Let's start with surrendering the policy to access the cash value. Surrendering the policy means that we want to terminate the contract we have with the insurance company. The cash surrender value, less any loans that are out, will be paid to the policy owner, and the policy will be terminated. So let's go back to year 20 so I can show you this. Okay, this is year 20. Doing some simple math, if we paid the $8,000 a year for 20 years, at this point, right, in year 20, we had paid $160,000 into the policy. There's between $191,037 and $225,675 cash surrender value. So let's say the cash surrender value is $210,000. You paid $160,000 into this policy. And let's say there are no loans out and you received a check for the $210,000. You essentially made $50,000. Who do you think might be knocking on your door? Did I hear you say the IRS? Do you have some income to claim? You see, while this money is inside a life insurance policy, there's a section of the U.S. Internal Revenue Service, the IRS tax code, the section 7702, that allows the money to grow inside a life insurance policy tax-free. But what happens when you surrender the policy? The short answer is that if you take more out than you put in, you'll probably owe some taxes. And I will disclaim, please consult a proper tax specialist to discuss your specific situation. I am only trying to share some simple strategies that might necessitate you reaching out to licensed qualified specialists in their own specific areas. Surrendering a policy, especially one that is performing as well as this one, should be the absolute last resort. As an alternative, why not take almost all of the cash surrender value out of the policy as a loan? Then you have a year to figure out your financial situation. And for the next premium payment, you could only pay the base policy premium to keep the policy in force for another year. Base policy premium, what's that, are you asking? All right, last point. Remember I said that this policy was designed to be overfunded. Well, the premium is actually divided into two parts. Let's take a look at the premium information. Okay, so we're taking a look at the premium information on this particular page in this policy. We can see that the total premium is $8,000. But it's because there's a base policy of the $3,054.58, and then there's an additional paid up additions rider for $4,945.42. The base policy is exactly what it sounds like. It's how much it costs to keep this policy, the base policy, in force. The annual paid up additions rider is the overfunding that we are doing to, as we said before, quickly grow and maximize cash value predictably and safely. So if we're in survival mode, I like to call it, when things get really tight and we could access all the money in our policy by taking out a loan, then we have a year to figure things out. Or then we can hopefully scratch together enough to maybe only pay the base policy premium of the $3,054.58 to keep our policy in force for another year, and hopefully by then have straightened out our finances, we go back on track with our policy. Now, there's a lot more depth information about this on another video, but I want to at least address these particular options here. I created this video so that I could break the numbers down and explain why I am so passionate about overfunding participating whole life insurance policies. I truly believe that if everyone really understood exactly how these policies work, everyone would be trying to figure out how they could set up as many of these as they could. While these policies are the backbone to starting and continuing to grow wealth, they are also a crucial component to where one holds their money. The most important aspect of these policies is how the cash surrender values are used. Money has to stay in motion to make money. And that is the subject of another video. Thanks for watching. Hope this helped.